The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Cracks in the job market, crinkles in the AI trade, but markets don't seem to care. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off the closing bell here in the U.S. Romaine mentioned those cracks appearing in the labor market ahead of tomorrow's jobs prints. That's actually sending stocks higher today. You can see the S&P 500 higher by about 0.6%. Big tech leading slightly here with the Nasdaq 100 higher by about 0.7%, sending yields lower, which is interesting, especially when it comes to the long end. You have 10-year Treasury yields below 420, down about 4 basis points on the day. And this is a reversal from what we saw yesterday when it comes to Bitcoin, actually lower on the day. The ultimate risk asset remained off by about 2%.
Fractional gains on the S&P and the Nasdaq, more meaningful gains on the Philadelphia Semiconductor Index, up more than 1% here on the day. It started in the red before flipping into the green. The red coming on commentary at that Citi TMT conference from the CFO of Texas Instruments saying a broad chip cycle recovery is, quote, not quite happening. But then Intel and other companies took the stage, giving more upbeat presentations. And don't forget, after the bell tonight, Broadcom, which makes networking chips with direct application for that AI infrastructure build out, they're set to report earnings. Full coverage coming up in just about an hour. The other big story is the continuing seesaw in Treasury yields and mixed economic signals. An ISM report today showing activity at U.S. service providers actually expanded at the fastest pace in 6 months. But that bumped up against data showing applications for U.S. unemployment benefits rising to the highest since June, and other data showing hiring by companies downshifting to the slowest for any August on record. And those mixed signals, of course, coming against the backdrop of what could be a massive reimagining of the complexion of the Federal Reserve and possibly its mission too. The political pressure to remove Governor Lisa Cook, that ratcheted up today by the Justice Department, while former macro strategist turned Trump acolyte Stephen Maier, he maybe is moving closer to Senate approval to join the Fed board.
Look, the president nominated me because I have policy views that I suppose that he liked. If I'm confirmed to this role, I will act independently, as the Federal Reserve always does, based on my own personal analysis of economic data, my own personal analysis of the effects of economic policies upon the economy, and act based on my judgment of the best economic policy possible.
And that was Stephen Maier, Trump's pick to replace Adriana Kugler on the Federal Reserve Board, with a lot of questions right now about the Fed's current state of independence and, more importantly, its future independence. Eric Rosengren joins us right now, the former Boston Federal Reserve Bank president. And Eric, we kind of start here with this idea, politics aside, as to the Fed's ability to make decisions based on the data, or at least based on its economic expertise, independent of the political pressure that we have seen ratchet up over the last 7 months. Is that possible?
I think it's possible, but it may be difficult in the circumstances we're currently seeing. Federal Reserve independence, or central bank independence overall, is critically important. As we've seen with the fiscal deficit, politicians have a tough time doing the right thing across the entire business cycle. So when the economy is doing poorly, you want more expansionary fiscal policy, but when the economy is doing well, you expect them to pull back on some of that expansion. Well, the same thing applies to monetary policy. You want interest rates to be low if the economy is weak, but you don't want to keep interest rates low when the economy is too strong and inflation's picking up. So a reason for having an independent central bank is to avoid the problem that you get a political business cycle as politicians try to lower rates in order to get an election outcome that's more favorable. And in countries that have tried to do that, they have not been particularly successful with containing inflation. So Argentina and Turkey are two leading examples of central banks that lost their independence and then had significant problems addressing inflation concerns.
Well, underneath kind of this debate, at least the high-level debate about what's going on with Fed independence, there has been a discussion that predates the Trump administration about whether the Fed's policymaking should be anticipatory, if you will, or should it be reacting to the data, basically the hindsight, if you will, or is there sort of a middle ground that, at least when you were at the Federal Reserve Bank in Boston, that maybe policymakers tried to land?
Yeah, a good monetary policy should be based on forward-looking what you expect to happen. So no forecast is going to be perfect, but you don't want to forecast and do interest rates just reacting outside of what is currently happening. You want to be thinking about what's likely to happen going forward. And so good monetary policy one reason you have so many economists at the Federal Reserve is that they try to do the best job they can at forecasting where the economy is going. And then if needed, they want to make an adjustment in interest rates to make sure they get inflation to 2% and unemployment close to full employment. So I think you don't want to be backward looking. You want to be forward looking. You want to base it on a forecast, knowing that almost any forecast is going to be wrong.
Well, if you're making policy based on what you anticipate will happen, I mean, the narrative has entered the market that you have the two sides of the Fed's dual mandate actually in conflict right now. It seems like the consensus is that we're going to see more labor market weakness. We'll have a better idea at 8:30 a.m. tomorrow morning. And at the same time, you have a lot of folks saying that inflation is going to remain sticky. Maybe it doesn't go up, but getting back to that 2% target certainly looks difficult here. I wonder whether you also see that conflict.
Yeah, there's clearly a challenge right now because, as you point out, core PCE has been picking up and labor market has shown some signs of weakness. Real GDP for the first half this year is roughly half of what it was the second half of last year. So the economy is definitely slowing down in the face of some of the actions being taken with fiscal policy. So that is a challenge for the Fed. But the Fed does have a framework that argues that when the two parts of the mandate are in conflict, you try to address it depending on how far away you expect them to be from where you want them to be and how long it's going to take to get back to where you want to go. So that would argue for thinking through how long you think inflation will be above 2% and whether you think the labor market is going to get weak enough going forward that it justifies, regardless of where inflation is right now at close to 3%, that you may want to ease. So I think the commentary we've gotten is emphasized concerns about the labor market, and things definitely have slowed down, as has real GDP.
Yeah, that certainly seems to be where the focus has shifted to. But using that framework, I'd love to hear your perspective on which side of the mandate you think is more urgent at this point, whether it is that labor market weakness that could come or potential inflationary pressures picking up here.
Well, I think the employment report tomorrow will give us some clue to that, as you just alluded to. But I think one of the challenges is the unemployment right now is right at the Fed's estimate of full employment. What's been weak on the employment report has been the payroll employment growth. And the problem with focusing on payroll employment is that there's both a labor supply and a labor demand shock. So by that I mean you don't need as much labor if the economy's slowing down, so that's a labor demand shock. And the labor supply shock is the immigration policy, where a lot of people are no longer in the labor force, and we've seen a significant slowing down of the labor force growth. So over the last 5 years, we grew roughly 2 million in labor force, and now over the last 6 months, it's basically been flat. So it's a little bit hard to interpret what the payroll employment growth should be in an environment where immigration policy has changed so dramatically.
I am curious, Eric. Earlier today, during Maier's hearing, the issue of the efficacy of labor market data was brought up. And I know there's been a lot of discussion about data collection practices, not only at the BLS, but other U.S. government agencies as well. I am curious as to how reliable you found those data collection practices when you were at the bank, whether you think they've deteriorated since, and whether there's anything that could be done to maybe improve the situation.
I think over the last decade, there have been reductions in funding to gathering data, and that's happened under both Republican and Democratic administrations. So we should be spending more money trying to collect good data. That being said, I don't think the data is biased. One reason we see large revisions is the payroll employment number is basically a survey of firms. And you send out the survey and a lot of firms don't respond, or they respond late. And so you have revisions over the next couple of months. So as long as we're relying on things like surveys for payroll employment, you're going to have significant revisions depending on how willing businesses are to fill out the surveys provided by the government, and the participation in those surveys have gone down, and there are less people that are analyzing the data than they had before. So I think that that raises a concern about whether we're spending enough money to make sure we get the best data that we need. But at the same time, I think there's no justification for the idea that the data is somehow biased.
All right, really appreciate you taking time for us, Eric. Eric Rosengren there, the former president of the Boston Federal Reserve Bank, as we count it down to the close with stocks near session highs, yields near session lows. And remember, we started this week with a big bond sell-off in the UK, and it ends this week with the big labor market report here in the US. Our next guest actually sees a link between the two. Elise Badoy going to be joining us in just a second, head of UK, Europe, Middle East, and Africa equity research at Citi. This is the close on Bloomberg.
Well, the next big catalyst for markets is, of course, Friday's jobs report. It even carries implications overseas, according to our next guest, who says that the euro's path hinges on the U.S. labor market, despite flare-ups in French politics. Let's bring in Elise Badoy. She is head of UK, Europe, Middle East, and Africa equity research over at Citi. Great to have you on set with us, Elise. And the importance of the U.S. labor print, I have to imagine that carries across asset classes here.
Well, of course, investors are very focused and have been focused, dare I say it, for, I mean, is it the last 2 years, you know, on the Fed? And obviously, it's the Fed moves would be a relief for any market, you know, any equity market around the world and the European one. And of course, as we look into potential headwinds for European equity market, and we have that French vote on Monday, we must be reminded that actually European markets have only 50% local exposure. And in fact, if you look at the CAC 40, it's only 20% domestic exposure. So when you mention the Fed, well, obviously that has, you know, it's very important. And the job market is obviously, you know, linking to the Fed. I jumped straight to the Fed because that's essentially what it means for markets. That's the transmission mechanism.
Right. Well, talk to us a little bit about those cross currents then. Of course, you have the labor market print, the implications of what that means for the Federal Reserve. But you think about the area that you cover and you think about that vote in France that we're getting on Monday. How do you start to weigh those factors?
So I think it's a balance of risk. And obviously, if we take a step back, we need to remind ourselves about the recent drivers we've seen for the European equity market and perhaps the French market. So, you know, up until December at Citi, we sort of turned more positive on the European market, but that was purely a function of really overly bearish positioning away, right? That position closed, and then we got some really good underlying fundamentals. We got positive German elections, which led to a fiscal stimulus, both for infrastructure and defense investment. All of that sort of drove uncapped growth, if you want, for Europe, which had been capped for maybe, is it a decade, in investors' mind. So it led to a really diversification towards Europe, away from the US. And we're still positive on the US, but we do believe there's value in that diversification. Does the French vote changes any of that? This is the question. It's the first headwind in a couple of months that we've seen in the scene.
Oh, sorry.
No.
When you were talking about this idea, though, of all of the interest people took in European equities, and I know some of that was coming from European investors. We also saw a lot of folks in the U.S., allegedly, I'm not sure what the data shows, rotating out of U.S. assets into some of those European assets. Was that a fluke? Was that just kind of people afraid of what was going on in the U.S., or did they truly see the potential for growth in Europe and some of those nations that you mentioned?
So, Romain, that has been absolutely the conversation for the past few months. You know, is this real? Is this the sort of the closing of the gap that we've been waiting for so long? I think the data in terms of flows, we saw flow picking up in Europe. We saw interest, first of all. So early January, for example, my team noticed we track readership, and European research all of a sudden was making the top ahead of, single stock European research was topping up the reads. So that was sort of interest. People were doing the work. Yeah. And then we saw the flows, the actual flows. So our strategies tracked the flows, and they were there. I think for big US investors to move more in Europe, you need liquidity, and it is a fact that some parts of Europe are less liquid. So typically, if you wanted to play that great sort of infrastructure run, for example, in Germany, you can probably buy the DAX, but can you buy the MDAX, which is all where the pure play is? It's difficult for a US investor.
Is there something beyond, though, defense, particularly for non-European investors? I mean, you're here in the US now, Citi's having a big conference. When we talk about the growth story here in the US, it's all tech, it's all AI. That's all anybody wants to be a part of. And I don't see as much chatter about that coming out of European companies. I mean, it's fine that your defense industry potentially is now going to see a buildup, but what beyond that?
And I think that's why, by the way, we're advocating both exposures. What we're saying is it wasn't probably right to be all exposed to only the US, which is why the underweight closed. You can grab some, there is an opportunity to be grabbed in Europe because of the valuation differential. So clearly you're buying cheaper asset, growth is less, but if growth is then now uncapped, you have an opportunity. You still have the AI opportunity, which is underpinning all the growth. And in fact, at the time, we would advocate any pullback, in any AI-driven stock, we would advocate is an opportunity still. So in terms of what's next for Europe, it's really that leadership question. I think the fundamentals haven't changed. They're there. The positive, the investment in infrastructure will be there. They need to meet the NATO 3.5% defense spends by 2035. That needs to happen. The question is, in the next 12 months, will we have the right leadership? And there is this perception that France needs to work with Germany. And if France doesn't have a strong leading government, it is difficult. It is difficult without a budget. And without a budget, it's going to be essentially an administrative budget, which will be a copy of this year, which is not going to reassure markets. Now, we believe the balance of the risk, when you balance everything, we will still that growth is still uncapped, but we will see volatility, especially around that vote. And it's especially around French equities, so the CAC 40. We noticed that even though I've said it, and I say it again, it's 20% domestically exposed, we have seen historically a big correlation between elections and volatility in the CAC 40.
Okay. All right. Well, we're going to maybe find out on Monday, September 8th, of course, with the potential vote there on the future of that government. Elise, great to have you here in studio, too. Elise Badoy is head of UK, Europe, Middle East, and Africa equity research over at Citi. Stick with us. When we come back, we turn back to the U.S. and we turn to Lululemon. They're set to report earnings in less than an hour, a preview of what to expect. This is The Close on Bloomberg. Let's get right to our top calls. The move is on the back of analyst recommendations, and we start off with Apple. MoffettNathanson, which began the year downgrading the iPhone maker to sell, citing high valuation, antitrust overhang, and a weakening position in China. Now flipping back to neutral, saying the worst case scenarios, at least for right now, are off the table. See those shares only fractionally higher here on the day, up about 0.1%. Next up, AMD. Seaport downgrading the chip maker to neutral, saying while AMD remains a viable long-term competitor in the AI accelerator market, it's becoming increasingly challenging for them to meet over-high expectations this year. Those shares moving slightly lower here on the day. And finally, Texas Roadhouse, Evercore cutting to inline, saying the steakhouse chain struggling amid a, quote, perfect beef storm. Cattle prices headed toward their biggest annual increase since the 70s, an inflationary spike the analyst says will carry on into 2026. Those shares moving lower by about 1%, and those are some of our top calls. Let's turn to a gainer on the day, and that is Lululemon, up about 3% as we await their earnings after the bell tonight. Joining us right now to talk about her expectations is Janine Stichter, Managing Director of Consumer Equity Research over at BTIG. Net revenue, $2.5 billion, EPS of 2.87. Those are the average of analyst estimates here. Are you expecting any sort of potential, Janine, that the company might actually beat that and, more importantly, guide higher for the year?
Yeah, well, we're thinking for this quarter that they come in line in Q2. We're at the upper end of expectations, but the focus is really on the guide. And if you look at where consensus expectations are right now, you'll see that estimates are generally below the guide that they've already given. The multiple has come in about 30% over the last few months. So that suggests that investors are expecting a big cut to earnings. That's on two things. It's on tariffs, which have basically doubled since we last heard from the company, and it's on the North America piece of the business where I think the expectation for growth has been ratcheted down. So we do think they will cut numbers. It's a reality that tariffs have moved higher. I do think the Americas business is still a bit sluggish, but our view is that the cut won't be as bad as expected and that there's still potential for some positive news out of this report in the form of a better quarter-to-date trend and some progress on the product newness initiatives that they talked about over the last 2 quarters.
So tariffs absolutely a headwind. This is a stock that's down 47% year to date, but it has issues beyond tariffs. You think about last year's performance down 25%. I'm curious to hear what is the biggest issue facing this brand right now? Is it shifting consumer tastes? Maybe people don't want leggings anymore, or is it the fact that you have some pretty well-established competitors at this point?
I think you have to separate it into 2 buckets. There's the issues that are controllable within the company's own execution, and then there's the out factors that are hitting the company right now. The outside factors, I would say, have been overstated. Certainly, there's more competition in the form of companies like Alo and Diori. But at the same time, we have competitors, Athleta, for example, which is owned by Gap, $1 billion competitor that's really struggling. So the competitive landscape is tough, but it's always been tough. We do have this element of leggings maybe being less popular than they were at their peak, but I think leggings are still a staple of the everyday woman's wardrobe. So these fears are real, they're out there, but I think they're overstated. What's not talked about enough in our view is what the company can do. And I think they've finally admitted that, you know, they haven't been bringing newness to the forefront enough. They kind of got a little bit complacent in their product assortments, and they've improved that. But we're seeing more of that ramp into the back half. So now that we're at this crucial juncture where if results don't improve, maybe it's more the external. But I think we're going to see some level of inflection in the back half as we get this better product in.
The product mix has been an issue. I am curious about the marketing side of this. I mean, Bloomberg has been reporting about some of the moves that Lululemon has been making to sign up big-name athletes like Lewis Hamilton, Tiafoe, and a few others, a strategy that it hadn't really employed in the past. Does that model work?
I think it does work, and I think it's the name of the game at this point. We've seen other companies, obviously Nike's been doing this for years, but even smaller companies now, like On, has done a lot of partnerships both in the athletic space and in kind of the broader lifestyle space. We're seeing that become more important, and I think it's just something that you need to do to play the game. Does it necessarily translate immediately to conversion? Not necessarily, but right now I think it's important to maintain mind share and stay top of mind with consumers, and having those kind of partnerships just helps you stay top of mind.
All right, Janine, really appreciate the preview. Expecting those Lulu results after the bell today. That is Janine Stichter. She is Managing Director of Consumer Equity Research over at BTIG. Meanwhile, coming up, shares of 1-800-Flowers sliding after the company reported not so rosy fourth quarter results. We'll discuss that report up next with the company's CEO. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld, and we're keeping an eye on shares of 1-800-Flowers. They are.
You got me something?
Not quite, but I have a great guest sitting to my left. Let me tell you about him. Shares of 1-800-Flowers falling after reporting thornier than expected results. That's another pun. Joining us to discuss is Adolfo Villagomez. He is the CEO of 1-800-Flowers.com. Great to have you on set with us. I understand that you took over this job in May. You said on the earnings call today that over the past few years that your customer retention approach was ineffective, your marketing spend was inefficient, and the expenses did not come down in line with revenues. So when you go through that list, what is your top priority to fix?
Hi, Katie. Thanks for having me. It is going to be a multi-year transformation. The way to think about it is, the way we're thinking about the roadmap is in the short term, we need to stabilize the profitability of the company. So this is we're building the foundation for growth this fiscal year. And we're also planting seeds to drive growth in the future. And so we believe that over the next few years, you will see a company that has stable earnings with top-line growth that delivers profitable bottom-line growth.
Interesting. So there's the long-term perspective and there's the short-term. When it comes to expenses, where can you cut back? What areas have you identified as a place to maybe bring those costs more in line with revenues?
So the company was built through acquisitions of multiple brands. We have 1-800-Flowers, we have Harry & David, we have Things Remember, Personalization Mall. We have multiple brands. They were never really integrated. A good example is we buy corrugated packaging in 4 or 5 different places. We can consolidate that and drive productivity. And We can bring together marketing and drive productivity. We can consolidate many areas and start driving productivity to help us be more cost efficient.
I am curious about the customer and customer acquisition. Is that strategy right now to bring in new customers, is that primarily through advertising and marketing, or are there other plans that you might have to try to sort of, I guess, generate interest and buzz?
So that is what is evolving. Today we have a strategy that is primarily driven on bottom of the funnel acquisition of customers. And what we are trying to do is to migrate into full funnel acquisition, create some brand awareness. We have amazing products that the customers are not aware of. So my job is to reorganize the team, change the strategy to go into full funnel, acquire the customer, and then have the right retention strategy so that you don't have to pay for a marketing acquisition again. And that will create a nice flywheel that will allows us to create value with the customer long term.
But how do you sort of get that retention and that repeat customer, if you will? I mean, obviously, when it comes to flowers or your gift baskets you're getting from Harry and Dave, it's not, for most people, that's not an everyday thing you're going to buy. And for some of us, it's a last minute thing because we always forget. But how do you sort of make sure that after I come and buy flowers with you for Mother's Day or for Valentine's Day, that I'm also going to come back for whatever other reason and think of you first, think of 1-800-Flowers first?
So, Two reactions to that. The first one is, historically, we have been in the gifting side of the business. We believe we have a lot of products for self-consumption. Harry and David sells coffee, chocolate bars, muffins, you name it. A lot of self-consumption, but the company strategy has been focused on gifting. What I tell the team is, guys, let's focus on gifting, but also self-gifting. Sometimes we buy things for us. So that creates an opportunity to build a relationship with the customer longer term. To be with the customer we're expanding our channels. Today, it's primarily we have our brand, and that brand sells on the website. And the new strategy is, let's be where the customer is. That means physical retail. That means marketplaces. That means other retailers. You can just go and buy a chocolate bar from our Harry and David branded. It's a brand that resonates with people. We're trying to put our amazing products wherever the customer is today.
That's interesting to hear that you're focusing on expanding the physical footprint, because I have to imagine that, you know, many folks who sell physical goods actually have been moving more online. So as you look to more brick and mortar locations, are you targeting a specific type of area? Are you targeting malls, for example, or what is the ideal physical location for you?
Wherever traffic exists, that's where we want to be. So we are launching, we're going to have about 5 Harry and David pop-up stores in shopping malls this holiday season to start testing. We're testing our way to find profitable growth. So as I mentioned to you, Harry and David has evolved from baskets, which are still amazing, into other products. So we're testing this assortment in the shopping malls to make sure that we're going to learn what customers want to buy from us during the holidays. And then from there, we're going to go into physical store, more permanent places. That is the path we're going to follow, but we're testing a way to make sure that whatever we launch is profitable.
And Adolfo, we don't have much time left, but before we let you go, you know, I mentioned that you took over this role in May. Previously, you were an executive at Home Depot, which of course has a very large garden division. What lessons can you bring and extrapolate from Home Depot into 1-800-Flowers?
I would say everything starts with the customer. That's what I learned at Home Depot is everything starts with the customer and an amazing value proposition for that customer. And then Home Depot was primarily stores, but I was running online, is how do you create that connection of whatever the customer is looking for, I have the product for you, and AI is helping us today to do that. So that's what I'm planning to bring to 1-800-Flowers is connect great products to consumers to create a transaction and go from there.
Adolfo, great conversation, and I wish you the best of success. And we've got to get you back on after you've had a little bit more time on the job to sort of get your feet.
Happy to come back. Thank you.
Adolfo Villagomez, the CEO of 1-800-Flowers.com. Now we turn from the business of flowers to, well, the business of sports. Right now, just, well, a couple floors above us, the Bloomberg Power Players Summit is underway. Guests from around the world of sports, both on the athlete side as well on the investment side. talking about what's next for the future of sports and for the future of media. One person has been really at the forefront of that for the last few years. Bloomberg reported that Ares just closed a $1.4 billion fund last month, a sports and media fund, led, of course, by the co-founder and CEO, Michael Arougheti. And pleased to say Michael joins us here in studio, too. Great to have you, Michael.
Always.
Now, you just got off stage.
I did. I rushed right down here.
We appreciate it.
Yeah.
I mean, it's a buzz. And it's kind of funny looking at this conference because I feel like 10 years ago, we would not have seen the turnout or even the types of people on stage like you. Business of sports has grown not just because of interest, but of accessibility.
I think that's right.
Talk a little bit about how much further it goes. And let's start with the NFL, because I know your panel was kind of focused on the football league here in the U.S.
Yeah, so to contextualize the NFL, maybe I think what you're articulating, up until 6 years ago, institutional capital wasn't really able to invest in the major leagues around the globe generally. And sequentially, they started to realize that there was value in bringing creative, flexible capital to support league growth, team owners, et cetera. So if you go back just 6 or 7 years ago, it was really wealthy people and banks, and there was nothing in between. Every other financial market that we play in the private markets, that ecosystem of capital innovates and finds ways to support the growth of a market, and that's what's happening in sports right now. What you realize once you start getting into it, everybody loves sports. You know, everyone's a fan of something. It's a part of their identity. It brings cities together. It brings countries together. And so the ability for people to now tap into that, that emotional connection is something quite unique.
I am curious on that point, though. I mean, you've had a couple of sports and media funds. I mean, the latest we just mentioned here. As that gets pitched to investors, do they buy into this with their heart, meaning like, okay, I want to, you know, I'm a Bears fan, or maybe Bears aren't the best example, but, you know, I'm a fan of that team that actually wins and I want to be a part of that? Or are they looking at it the same way they would look at buying a stock, a bond, or something else?
I think it's a financial investment. I mean, the good news is, like, for example, we just exited our investment in McLaren, and it was a wonderful investment for us over a number of years. So I think they're leading with the financial instrument. You know, the beauty of sports investing, these are exposures that you can't get anywhere else. They're non-correlated to anything else that you can invest in. And generally speaking, they've been going up 10 to 15% per year for the last 15 years. So it checks every box on the financial side. I think the emotional connection is kind of the gravy on top. I don't think anybody invests in our sports fund just because the love of the game, right? But if you get to interact with these brands and these teams and make good returns, then, you know, of course that's better.
Maybe similar to investing in equities. You know, you want to invest in the best companies, and maybe it helps if you like them as well. But to talk a little bit more specifically about this fund, it launched in mid-July, this sports and media fund specifically for individual investors. What does the uptake look like so far?
We just launched it in June, so it's early days. This is on the heels of our first institutional fund that we raised in 2020 that aggregated to close to $5 billion. We invested that well across the global sports media and entertainment landscape. And what's happening now in private markets, we've talked about in other conversations, the opening up of the wealth channel to invest in private markets is now coming together with this opportunity to invest in sports. And so we think that we're kind of leading the way in bringing access not just to the institutional market, but to the individual market.
Right.
As you mentioned, the $1.4 billion that you reported on, this is a perpetually offered permanent capital vehicle, so our expectation is it will continue to scale.
Well, let's talk a little bit more about opening up private markets in general to more investors, because there's been a lot of talk about partnerships. You know that Vanguard and Wellington have partnered with Blackstone for that effort, expanding private assets to maybe individual investors. Just today, we learned about Goldman Sachs investing, actually buying up shares of T. Rowe on the open market with the idea that they're going to launch some of these vehicles. I know that you said last month that you've been talking to partners, having those types of conversations. Now we're sitting here in September. What do those conversations sound like?
It's more of the same. I mean, partnerships, we've built our entire business based on partnerships with our investors and our clients, and it kind of cuts to the DNA of Ares. This whole public-private thing is an interesting evolution because we're all theorizing that there's investor demand and appetite to buy public exposure and private exposure in one place from two different firms. That hasn't really been proven yet. But if the investor says that they want it, we have to be there to meet that demand. So the conversations generally are trying to tease out exactly what we think that demand is, what's the value proposition to the customer, what demand is it replacing, and can we actually deliver the product to the client in a way that makes sense for them? T. Rowe and Goldman, by the way, two great firms that we have partnerships with in other parts of our business. I couldn't be happier for them, but it's still early days, right? There's a long way to go from saying the 401k market's going to open up to private capital and the whole world as we know it has transformed versus there's a lot of administrative, legal, regulatory, legislative changes that need to happen to see that actually have an impact. So we tend to be a little bit more intentional and measured in the way that we're jumping into these things. But if and when it happens, we'll be there. And I think that the partnership opportunities would be significant.
What is the health right now in the private credit space?
In terms of company performance?
Yes.
As good as we've seen it.
Yeah.
I think people have been expecting that we're going to see cracks in the portfolios now for quite some time.
Yeah.
Obviously, earlier in the year, there was anxiety about recession, and now we're seeing a reacceleration of earnings growth. But in our private credit portfolios, non-accruals are near all-time lows, defaults are low, interest coverage is improving, EBITDA is growing low double digits. So I think the economy is continuing to show a lot of resilience.
But in that space, at least in terms of the activity, particularly with new issuance, particularly with just money flow overall, obviously secondaries have been a huge opportunity this year. And some would say for a good portion of the year, probably the only opportunity. I know this was raised on the earnings call a few weeks ago. And it seemed that, at least for new secondaries, you're doing pretty well there. I think
our secondaries business is doing great across the board.
Yeah.
Credit, infra, private equity, real estate, big liquidity provider into a market that's struggling with return of capital.
I do wonder about deployment opportunities. I believe in August you said that your managed assets are more than $572 billion at this point. How much dry powder do you have?
Oh gosh, I think it's about 140 billion. So we typically run 20 to 25% of our AUM in dry powder. Now, mind you, that's across global landscape of equity and debt, real estate, infrastructure, credit. So it may seem like a lot of capital, but that's generally been our annual deployment has been plus or minus 100 billion. And if you look at the quarterly deployment numbers, we've been keeping pace with that. So I think there's a misperception in alts that we're M&A dependent, and that if the M&A market is slow or the capital markets are, not open, that all of a sudden our deployment dries up. That hasn't been our experience.
All right, that's a good place to leave it. Great to get some time with you. That
Always
is Mike Arougheti. He is co-founder and CEO of Ares Management. And I guess, having a lot of dry powder, Romaine, it's kind of a champagne problem.
Yeah, I mean, well, it depends.
There's worse problems to have.
For some people, it's just, a Prosecco problem.
It's true.
Sparkling wine.
That's true, a champagne problem. Coming up, we'll take you to the closing bell with Keith Lerner. He is co-chief investment officer and chief market strategist over at Truist Advisory Services. This is The Close on Bloomberg.
I think one of the challenges is the unemployment right now is right at the Fed's estimate of full employment. What's been weak on the employment report has been the payroll employment growth. And the problem with focusing on payroll employment is that there's both a labor supply and a labor demand shock.
Eric Rosengren, the former president of the Boston Federal Reserve Bank, he kicked us off to the close just about 50 minutes ago with the focus, of course, on Federal Reserve independence. Of course, the big hearing for Stephen Maier today on Capitol Hill. And the market's not really all that concerned about it, at least not for now.
Not for now, of course. We're all waiting for tomorrow, as our next guest says. But you can see the S&P 500, unless something amazing happens, going to finish about 0.7% higher. Big tech in the lead here. I will note that volume is a little bit lower versus the last 30-day average. Of course, we have that all-important payrolls print tomorrow, so just waiting here. You can see the 10-year Treasury yield lower by about 5 basis points. We did get initial jobless claims higher this morning. You also had ADP coming in a little bit lower versus expectations, a bit of a preview there for tomorrow. And then Bitcoin. I put that up because, again, I think of Bitcoin as the ultimate risk asset. And it's interesting to see stocks rallying right now, Romain, but Bitcoin down on the day.
Yeah, and don't forget also we are going to get some corporate earnings after the bell tonight, including from Broadcom. Of course, that big networking chip maker here, a direct connection to the AI center build out. DocuSign, Lulu also reporting, as is Copart and UiPath. Keith Lerner joins us right now, the co-chief investment officer and chief market strategist at Truist Advisory Services. And Keith, I do want to start off with the tech trade and the AI trade. There was a little bit of concern earlier this morning out of some comments coming out of a Citi technology conference. We saw this Philadelphia Semiconductor Index in the red. It flipped into the green. And it gets to this idea that there seem to be a lot of investors really kind of not quite sure where we go next with this AI trade. Nobody seems to doubt the long-term trajectory of this. But in the intermediate term, I am curious if you see any potential for a bit of a pause or pullback in that trade.
Yeah, well, first, great to be with you all. Our big picture theme is we still like tech long term. We still think AI is the dominant theme of this bull market, and the earning trends are the strongest in tech. However, on a short-term basis, the 4-month return for the S&P technology sector was 50%, 53% into mid-August. That's the most extreme returns we've seen since 2000. Now, that number 2000 may scare people because they associate it with the technology bubble, but to us, that just means things got a little bit stressed on a short-term basis. We need a digestion period. If we zoom out a bit, if we look at a one-year basis, year-over-year, returns are not extreme. Around 30%. That's a lot different than the near 100% returns we see at, kind of warning signs for the technology side. So all in all, I guess, the way we're thinking about things is we still want to stick with that dominant theme of AI, but in the interim, I think money is rotating to other areas like we're seeing today's small caps, and there's more focus on this, this most likely rate cut that we see in September. But I think eventually by the end of the year, we'll see money rotate back to tech, but it's not going to be linear.
Yeah, and it's kind of interesting, too. I mean, earlier today, some colleagues and I were talking about how when you look at a lot of the big tech stocks, particularly in the AI space, they really haven't seen any new highs since some of those mid-August moves that we saw. But, of course, that could change. It gets to the idea, though, Keith, about just broader investor sentiment, how they are feeling about valuations right now, and more importantly, about the economic backdrop and, of course, all the, political noise, if you will, coming out of Washington.
Yeah, I think right now what's interesting in the market is you can point to a good data point or a bad data point. Market valuation is expensive, or or more average, depending on what you're looking at. So I think that's what's causing a little bit of angst. This morning, if you look at the latest sentiment survey from AAII, we still have more bears than bulls. So I don't sense euphoric. Valuations are rich, but that's mostly because of tech. If you look at the equal weight index, you have you have a PE around 17, which is around the 10-year average. Small caps, which we're seeing some catch up today, are also more reasonable. Underperformed large caps by about 40% the last 3 years. So I just think that overall we're seeing a bit of rotation. But I think what's an important story not to be lost is that we're actually seeing the earnings story actually broaden out quite a bit. During the last earnings season, we did see the Mag 7 grow earnings around 26%. That was about double expectations. But the rest of the S&P, the 493, came in around 8 or 9%, and that was much higher than the 2% expected coming into the quarter. So I think that is a good sign that we're seeing those earning trends broaden out beyond tech.
Broaden out, tech still remaining dominant, but I'm glad you brought up sentiment and the fact that it doesn't feel euphoric, because you take a look at what is going on with gold hitting record highs. You're also seeing a big flood of money coming into gold tracking ETFs. I mean, how euphoric can this market possibly get if you're seeing such a bid here for gold?
Yeah, and I would say there had been pockets like, the high beta trade, the meme stocks. But when you look at the overall composite of sentiment, it's mixed. And going to your point about gold, I think the gold is more of kind of concerns about the U.S. dollar, the fiscal deficits. We're positive on gold. We've been positive on gold all year long. It consolidated for about 4 months sideways, just broke out. So from a portfolio diversifier perspective, we still think it makes a lot of sense. But to your point, it's not something that you would expect to be rallying a lot when everyone's euphoric about the world and so forth. So it is an interesting dichotomy.
Can you map some of that over what you're talking about over to what's going on in the bond market? Because you mentioned concerns about the deficit. You do see the long end actually catching a bid here. And then you think about some of the economic concerns out there. And you also marry that into what's going on in the bond market. The bond market has been really hard to make sense of all this year, Keith. And I just wonder how you're reading the different cross currents there.
Yeah, well, you said it, it's cross currents. It's complicated and it's not straightforward. I think what surprised a lot of investors, though, we talk about fiscal deficits and concerns about inflation. The 10-year Treasury yield year to date is actually lower than where it began. And even though there's a lot of concerns about our fiscal position, obviously what we've heard about over the last week from Japan, the UK, and so forth, we actually look like a place of stability overall. So I think what you're seeing in the bond market is it's actually now starting to focus a little bit more on kind of the softening in the labor market and the likelihood the Fed will start to cut rates. Our expectation is likely 2 rate cuts before the end of the year, and I think that's also helping to pull down that 10-year Treasury. But those fiscal deficits and so forth probably also put a floor on how low that 10-year Treasury goes to.
Well, assuming we start to get those rate cuts, and pretty much the entire market assumes we're going to get something in about a week and a half's time, and let's say we get another one this year, does that meaningfully change does it change valuations, I guess, or at least the valuation read does, 25, 50 basis points?
I think it's on the margin, right? I think to your point is 25 or 50 basis points isn't a dramatic change. Directionally, it does matter. But also, we have to also think the economy was somewhat less interest rate sensitive on the way up, right? Because so many people had locked in rates. It may be somewhat less interest rate sensitive on the way down. But you will on the margin. We know like small caps have a lot of floating rate debt. We know some of, the credit cards, autos are kind of tied to this. And it's also a signal. And I think it's also, our expectation is we'll have some follow-up cuts next year as well. So again, it's on the margin that helps out. We have the passage of the tax bill as well, and maybe some deregulation. You put that all together, you're getting some stimulus. But to your point, is it a panacea? No, but on the margin it helps out. And It is, if you look at the market, it is driving the rotation trade.
Keith, we've got to leave it there. Keith Lerner, Co-Chief Investment Officer over at Truist Advisory Services. As we count you down to the closing bells, we want to bring your attention to some breaking news, once again, out of Washington. When we started this show, Katie, there were some headlines crossing the wire about the FTC chairman basically criticizing non-compete agreements. Now we're getting a headline saying that President Trump is asking the Supreme Court to let him fire the FTC commissioner. I'm not sure if these two things are related here, and there's a lot we don't know. But the headline crossing the wire right now is that Trump is now targeting the FTC commissioner, Andrew Ferguson.
Yeah, we're going to have to get some more detail here. Of course, it is interesting to see that, as you mentioned, just about an hour or 2 hours or so after we saw that X post about non-compete agreements, we know that those have come under scrutiny. And I mean, just aligning the facts, maybe Donald Trump is a big fan of non-competes. Who knows?
Well, it was interesting, too, because when I saw those, I thought, OK, how important is this? We should point out Ferguson was appointed by President Trump. So this is his guy. He came in January of this year. But as, of course, we've seen with other officials in this administration, just being appointed by Trump doesn't necessarily mean you have job security.
That's true. And we can see that across agencies, too, when those picks are ultimately turned on. So we'll have to continue to follow that story. But just to read that red head once more, President Trump asking the Supreme Court to let him fire the FTC commissioner.
And we should also point out, of course, the FTC does play an instrumental role in signing off on mergers and acquisitions. And, of course, we've seen deal-making pick up here as we get deeper into the second half of the year. Romaine Bostick alongside Katie Greifeld with the closing bells in New York. Ulta, look at that, ringing the bell there over at the Nasdaq.
There we go.
The Dow Jones Industrial Average up more than 300 points, or about 0.8% on the day. The S&P 500 now looks like it is going to close higher for a second straight day. And that number is significant, 6501.97. Now, it takes a while for these numbers to settle, but if it holds at 6502, that's going to be a record high of 54.8%. The Nasdaq Composite up 200 points or 1% on the day. The Nasdaq 100 on its best two-day run in several months, and the Mag 7 as a group staging its best two-day rally since May. That's closing at a record high. The Russell 2000 higher on the day by 29 points or 1%. I mentioned Katie Greifeld. She is the co-host of this program. But to our left, joining us here in Studio 2 is Bailey Lipschultz, who helps to lead our coverage here at Bloomberg. Quite a day. And it didn't start out like it was going to look like this. It looked like we were going to be in the red. And for some reason, a switch flipped.
And then a lot of bullish
what happened?
optimism.
Yeah.
buyers momentum and just more buyers than sellers, it seems like. Obviously, the big job data tomorrow.
Thank you.
So as we see some of these reactions, it does seem like, I don't know, I don't want to call it FOMO, but it definitely is a chasing momentum thread.
Yeah, you have to wonder, of course, what the reaction is setting up for when we get those jobs figures at 8:30 tomorrow morning. We did get weaker than expected jobs data when it comes to initial jobless claims coming in higher, ADP coming in softer, but never trade ADP. That's something that I've been told a lot. Let's take a look at the sector breakdown here in this market. It was an up day overall, and boy, look at that circle. It's filled with green. One of the biggest components there is, of course, the discretionary sector, up about 2.3%. Big tech also fighting as well, higher too. So too were communication services. The lone red slice there, utilities, not having a great day, but overall, some really fantastic breadth heading into those all-important jobs figures.
And Katie, you talk about a lot of green. Why don't we start with looking at some of the gainers in the market, and the best performer in the S&P 500 today, that is T. Rowe Price, rallying after a $1 billion deal with Goldman Sachs, which will invest in the asset manager. Wall Street on both sides of this equation saying this is a win for both companies. It will allow Goldman to use its balance sheet to hold equity in T. Rowe. They're going to collaborate on retirement savers and wealthy investors, really partnering together. So that's why you saw a big pop, though. We did see shares pull back quite a bit over the course of the day. And then another outperformer was Gap. Katie, I don't know about you, where you buy your beauty products, but it does seem like Gap rallying today after plans to sell some beauty items and accessories in Old Navy stores, up almost 6%. Closing at the highest level since May.
Yeah.
Would you buy?
I probably wouldn't. I mean, I get my makeup done professionally here, and then.
Oh, not to brag.
I don't do anything outside of this building.
I just want to point out an honorable mention on there. American Eagle continues to kind of be the star of the show. A 38% pop in the shares today. Biggest gain since it's been a public company, going all the way back to 1994.
Incredible.
Did they sell makeup?
I don't think so. I haven't been in an American Eagle since I was probably 16.
You know, I was there about 3 weeks ago, and it was crawling, of course. Maybe that was back to school. I feel like we didn't spend enough time, though, on T. Rowe. I think that's such an interesting deal that Goldman and T. Rowe have worked out. The fact that they're going to buy up to $1 billion worth of T. Rowe shares in the open market, that would make them, theoretically, one of the top 5 biggest shareholders in T. Rowe.
Yeah, and this is a company that, for all intents and purposes, has struggled. Again, it's closing at the highest level since February, but if you pull up a chart of T. Rowe Price going back, call it, I don't know, 5 years, right now it closed at $111. Back in 2021, it was at double that. So we are seeing, I don't want to say maybe Goldman buying the dip since it's been 5 years or 4 years, but seeing the company really partner there. But talking about some stocks that have been under pressure, want to pivot to the decliners today, guys. 2 of the worst performers of stocks that I had on my screen, one of them is Figma, a name I'm very familiar with. This coming after it reported its results for the first time since going public, down 20%. Though, guys, you got to keep in mind, this is still a stock that is up about 65% from the IPO price. So when you're up essentially doubled, that's a higher bar for investors. So that's why we saw shares under pressure today. Another weak performer after results, Salesforce. This is a company that is one of the biggest tech companies in the world, falling almost 5%, biggest drop since April. Really looking kind of the analyst reaction. This is a company that didn't provide enough kind of for follow through or enough kind of reason to buy the stock.
Okay, so that was more of the earnings story. I am curious, though, too. I mean, we did see some softness in a couple of chip stocks, including Texas Instruments, and we're awaiting earnings out of Broadcom a little bit later. Obviously, 2 different companies in terms of the types of chips they make. But what's been the chatter right now about kind of the sustainability of just the AI trade, the chip cycle, et cetera? I mean, there's still enthusiasm for that?
I think there still is a lot of enthusiasm, but when you look at the results and you look at kind of talking to investors and market strategists and analysts, the big question is, can you deliver to the upside? And obviously, this is a market that is trading at all-time highs or near all-time highs. So if your stock is kind of picking up this momentum, you have to give investors a reason to buy. So we are seeing investors chasing some of these stocks, but also you got to deliver.
All right, let's stay in the retail space right now. Lululemon shares taking a dive here in the after-hours trade. The earnings crossing the wire right now. 2Q EPS a beat, $3.10. The street looking for $2.87. 2Q revenue, pretty much in line with estimates, $2.53 billion. But going forward, the company says net revenue will be in a range slightly below analyst estimates, 2.47 to 2.5. The street was looking for 2.5. 2.56. High end of that range, below the average of analyst estimates. On the EPS side, a similar story, 218 to 223. The street on average was looking for 290. So a miss and a miss on the guidance for the quarter that we're in right now and for the full year. A similar story. I'll just read you the numbers if you want them. Katie, net revenue 10.85 to 11 billion. That's the range they gave the street. Their previous guidance was 11.15 to 11.38, so guiding lower on full-year net revenue, also guiding significantly lower on full-year EPS, 12.77 to 12.97. They had seen as much as $14.78 coming in for the year.
Well, you can see the reaction in shares right now, down 13% in the after hours. Taking a look at the statement, we're getting some commentary from CEO Calvin McDonald saying, well, we continue to see positive momentum overall in our international regions in the second quarter. We are disappointed with our U.S. business results and aspects of our product execution, saying that they've closely assessed the drivers of the underperformance. They're continuing to take the necessary actions here, Romain, but it doesn't look like shareholders have that patience right now.
Poonam Goyal joins us right now, who covers this stock for us over at Bloomberg Intelligence. We should point out, Poonam, I mean, this is basically going to be the third straight quarter now that we've seen a negative reaction in the markets to the earnings, or I should say the report coming out of Lululemon. Can you kind of just articulate what exactly is going on behind the scenes?
Yeah, so I think the guidance is the problem, and the guidance is short for a variety of reasons. But I think the biggest reason is, one, the sales shortfall. If you look at the guidance carefully, you'll see that sales are expected to only rise by roughly low single digits, which is well below consensus estimates and even what they had guided to before. Now, the other thing is tariffs. We know that the tariff hit has doubled since the last time they reported. It was 10% estimated at that time. Now it's closer to 20%, given the new tariffs that were placed. That's a big hit to their gross margin, and we think that is the biggest drag that you're seeing on guidance. So all in all, the guidance isn't looking great. There's really no way to offset this hit because they really can't afford to raise prices extensively, so they will take a hit to gross margin.
And to that point on tariffs, also seeing commentary from the CFO, Megan Frank, saying that we're also navigating industry-wide challenges, including higher tariffs rate. And Poonam, you made the point. I mean, when it comes to levers to pull here, they can't really raise prices. There isn't exactly that pricing power that maybe might have existed in quarters past. So what can they do here?
It's about introducing new product. It comes back to, if you bring new product to shoppers, they don't know what the price was before, right? So you can price that right. The other thing is they cited a $240 million impact to gross profit. It was 50 million prior. So just the magnitude of that increase is something that they can't afford to offset, or especially through prices. It's just not possible. The consumer will not pay another 20% for the black leggings. They know the price of that.
Poonam Goyal over at Bloomberg Intelligence. Poonam, we'll let you get back to it here. Lululemon, one of the biggest decliners in the after-hours trade. We're going to get you some more details on that. Meanwhile, one of the biggest gainers in the after-hours trade is DocuSign. That company's earnings just crossing the wire right now, and it looks like a beat on several key metrics here, including on the bottom line, 92 cents versus an estimate of 86 cents. And the guidance going forward, the company says that for the full year, it's guiding slightly higher, 3.19 to 3.2 billion on the revenue side, and for the current quarter, 804 to 808 million. The street was looking for 797, Katie.
Yeah, you can see shares rising about 10%. Some needed good news for this company. We'll be speaking to the CEO tomorrow at 3:30 p.m. Don't want to miss that. But coming up next on The Close, Broadcom set to report at any moment with the chip sector, a big story in today's market action. We'll break down the results the second they hit the tape. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bostic. Just 1 week ago, Katie, the S&P 500 crossed the 6,500 mark for the first time ever, a record high. And well, today it topped that only by a smidge, 6,502, up about 0.8%. But given how we started the day, where it looked like stocks were going to end the day in the red, I think most people will take it. 2 straight days of gains for the S&P. The Philadelphia Semiconductor Index, which was down about 1% earlier in the session, closing out the day higher by about 1.3%. And keep an eye on the yield curve. Of course, Treasuries will be in big focus, particularly around 8:30 a.m. tomorrow when we get that monthly U.S. jobs report.
So you're taking a look at the trading day that was. Let's take a look at the after hours and some of the notable movers there. We have a tale of 2 earnings. Lululemon absolutely plunging right now, down about 13% after hours. Of course, they cut their full year EPS forecast, partly blaming tariffs. We know that that is an issue for Lulu, but this is a company that has a lot of them. So you can see shareholders not exactly patient here. DocuSign, though, a totally different story, posting a beat and raise quarter. Their guidance beat the average analyst estimate. They also boosted their billings guidance for the full year. You can see that's being rewarded right now. DocuSign up about 8.5% after hours, Romain.
All right, let's take a look here at what's been going on in the chip space. Texas Instruments was one of the biggest decliners today. The Citi TMT conference, some somewhat, I guess, retrospective comments there by the CFO. Meanwhile, we are awaiting earnings out of Broadcom, a big maker of networking chips. And earlier today, AMD, it was actually downgraded over at Seaport Global Securities. Some concerns here about the supply chain and whether it's pointing to slowing progress in AMD's AI accelerator business. The person behind that call joins us right now. Jade Goldberg is analyst over at Seaport Research Partners. And as we await those earnings out of Broadcom, I do want to start on AMD, Jay, and what is actually giving you concern?
So I think the concern I have here at AMD is there's a lot of expectations built into their numbers around AI. They're a good company. They're executing in PCs and CPUs well, but really investors are focused on the AI story around GPUs. And I just think they're having a harder time than we would like selling the current generation and the next generation of their GPUs. They're up against NVIDIA, which is pretty formidable. And what I'm hearing is that there are a lot of customers out there who are buying AMD sort of in small amounts, evaluating it, testing it. They want to keep AMD relevant, but they're not really ready to commit to larger and larger orders. So that just makes me call into question the timing of numbers. And so I think this year, next year are going to be a little bit slower than the street is expecting for AMD. And then the roadmap gets pretty impressive beyond that, but that's kind of out beyond most investors' time horizons.
And it's kind of curious. I mean, for every chip stock out there, or at least the ones that aren't named NVIDIA, there's been sort of this question as to where do you fit into the AI space. Broadcom, of course, is one of those names. And actually, let's just pause for a moment, Jay. We are getting those earnings crossing the wire right now. We're going to read them out for our viewers here. Adjusted EPS, Katie, coming in the quarter at $1.69. That looks like a modest beat. The street on average was looking for $1.67. Revenue in the quarter, $15.95 billion, a bit more of a beat. The street was looking for $15.84 billion. And we should point out that the semiconductor solutions revenue, a key metric, coming in slightly above estimates at $9.17 billion. Now, here's your forecast. The company says that semiconductor revenue for the fourth quarter, wow, it will actually decline a bit to $6.28 billion, but we should point out that it's higher than what the street was expecting. The street was looking for about 5.82. So it looks like a modest beat, Katie, in the most recent quarter, and a modest guide higher for the current quarter that we're in right now. And you see the shares up about 2.5%.
Yeah, trying to decide what to do, though, up to 1% right now. Initially, the knee jerk was to send shares lower. I will say, of course, that this is a company that had pretty sky high expectations. You consider Broadcom shares up 31% through today's close for the scope of 2025. And Jay, I know you've had seconds to digest those figures, but when it comes to a company such as Broadcom, we were talking about how difficult it is to be a chip maker that is named anything other than NVIDIA, but there's been a lot of calls for Broadcom to actually be put into the Magnificent Seven. They have had a great year.
I think Broadcom has had a great year, and it's a great company. It's probably the best run company in semiconductors today. I think the truth of it is, anytime NVIDIA loses share today, it's not to AMD, it's to somebody who's doing their internal silicon, and Broadcom is helping them do that, right? And I think very much the AI semiconductor contest of the next few years will be NVIDIA with its fully integrated solution. They do everything, versus Broadcom, who brings lots of different pieces to it and lets customers design their own custom approach. Those are the two who are really dominating the market now.
I am curious too. I mean, why don't you think we've heard a little bit more about what Mach Tan has been doing over there? And I know some of it is just the star power of some of the other CEOs out there, but I think there's a legacy side here where people just kind of look at Broadcom and they just think, old smartphones and other things. Are they in a space right now where what they offer as far as having a stake in that AI build out is as formidable in a different way than NVIDIA, but as formidable as NVIDIA?
Absolutely. And I think part of the challenge is that Broadcom does a lot of other things, right? They have this huge networking business. They do a lot of connectivity. They're on every iPhone. They also now have lots of software businesses. It's a much more complicated story than NVIDIA, which is just AI, right? All we talk about with that. And so sometimes it's hard to tease out the details of their AI story, but they have a pretty big opportunity here, right? And the way I think of it is the core business is really strong. AI is a lot of the upside, right? And I don't think the street really fully appreciates the size of that business for them.
I will say that Broadcom shares now down after hours. It's going to be interesting to see what executives have to say on the call. Might help give some shape to this after hours trade. I do want to go back to AMD briefly here. I know that you cut them to neutral on that slow progress in the AI business, but I want to bring in the political angle as well. We've spent a lot of time talking about the U.S. government potentially taking a 15% slice of Chinese chip sale revenue. We mostly talk about that in the context of NVIDIA, but AMD was included in that as well. And I wonder how you approach that as an analyst covering this company.
So they're very much in the same boat as NVIDIA. They have cut a deal on, at least on paper or on tweets with the U.S. government where they're going to pay 15% tax basically on their China revenue. But none of the specifics of that have actually come out. I don't think it's papered. NVIDIA certainly made it sound like they're going to need congressional legislation to make all of that happen. So we're very much in wait and see mode here. Generally, I think that China is it's an important market for AI. It is, I think, particularly important for AMD because it's another source of customers that they're going to need to get to. But it's hard to forecast beyond that because so much of it is in the political process, which is highly uncertain.
Yeah, to say the least. Jay, great to get some time with you. That is Jay Goldberg. He is an analyst over at Seaport Research Partners.
Yeah, we're going to keep an eye on what's going on there in the public markets. But I want to turn to the private markets. A lot of IPO activity, including Klarna, which we already knew was expected to price next week. Now learning, according to people familiar with the situation, that StubHub and Netspoke both are said to begin IPO marketing as soon as Monday. Of course, StubHub, the ticket reseller, and Netscope, the cybersecurity company. We'll try to get you some more details on that. Stick with us. This is Bloomberg.
Well, the ETF boom may be at a tipping point. The number of U.S.-listed ETFs is now officially higher than the number of U.S.-listed stocks. And one wealth manager warns of the surge, saying, quote, there's a paradox of too many options where investors can feel paralyzed rather than empowered. Let's unpack those implications with John Maier. He is Chief ETF Strategist over at JPMorgan Asset Management. John, great to see you.
Great seeing you guys.
Let's talk about that paradox because, you can feel any way you want to feel about that stat. The point has been made that there's more recipes than there are ingredients, but on that idea that there might be just too many options for investors, I would love to hear your take.
Well, yeah, there are a lot of options, but you have to remember not every ETF is on every platform, and that's really important. Distribution is super important in the ETF business. So if an ETF is not at Merrill or Wells, a client doesn't have access to it. And those are a little more curated on those platforms. So there's a lot of ETFs out there that are levered or inverse or more esoteric coverages that most investors are just not going to buy.
Absolutely.
Can I just share a story with you,
Yeah,
Katie
I was hoping you would.
And you too, John. I've been getting my son into investing, and you can let him pick stocks. You know what he said to me last night because he wants me to help him buy something? You know what he said?
What?
He just wants to buy the triple Qs.
The triple
And I
Qs.
thought, my man.
Yeah, man. Well, those are power tools, as Eric Balchunas would say, but he's young, so he's got a lot of time to learn those lessons. But when it comes to just the sheer number of ETFs, we talk about the number of launches all the time, but we don't often talk as much about the number of closures. And like you said, this is an industry where distribution matters. I wonder when we think about this boom that we're seeing at some point, if you're a pessimist, does this just turn into more funds shutting?
Yeah, I mean, if you look at the number of funds that are actually $1 or $2 million or even $200,000, like the barrier to entry to come out with a fund is low. Ever since the ETF rule came out in 2019, you could come to the market with, seed it with a couple $100,000, or JPMorgan could come out and seed it with much more than that. The playing field is level. So there'll be a lot of closures, and a lot of people just don't have access to a lot of these funds. Yeah. A lot of people don't even know they exist. So the way I view it is you look at the funds that meet your investment objectives and look into that category, and that's where you're really going to kind of focus on.
Yeah. I'm curious, in terms of some of the thematic funds out there, I mean, what are people still gravitating to most? Is it just what? AI, I assume. I know it's kind of a dumb question. But I ask that because it also gets to the idea, and in her intro, she kind of talked about, all these options. I mean, it's kind of like, you go into some of these like fast casual places. Some you can just point it and say, I want that bowl, and others you have to like pick and choose each, which I hate picking and choosing because I don't know what I want. Just make it my, just give me something preset. Do people want that optionality, or do they want something a little bit more preset, like a broad, triple Qs or maybe a broad AI robotics type of ETF?
There has been a little bit of a resurgence in thematics, and I think people think they want something, but with something comes something else. And let me explain that. With a thematic ETF that is very volatile, you put that in your portfolio. What does that do to your portfolio if you put a large amount? Yeah. So you really need to risk manage. That's why a financial advisor makes a lot of sense. And you look at some of our funds, like if you want to be exposed to the AI theme, like a JTech, which is our technology ETF. In the active space, you have an active manager selecting individual securities that make sense for the long term. You're looking at earnings, you're looking at revenues, you're looking at different exposures within a particular company and putting that into a broader portfolio. So it's more curated than buying something that's just a purely thematic exposure to robotics. Say.
Yeah. Oh, sorry, that's me. John, I'm sorry, I'm losing track of thought.
You're just daydreaming about Jeppy.
John, great to have you here. No, you make a good point, a really salient point, and obviously your expertise on this over the years, I think really speaks to why we have so many products, but also the idea that there is demand, at least for a good chunk of those. John Maier is the Chief ETF Strategist over at JPMorgan Asset Management. All right, as we head towards the break here, we just want to bring your attention. There was a story just a little while ago coming out of Reuters about Starboard taking a stake in Bill.com. Of course, a couple days ago, we were talking about Elliott now sort of shaking the doorknob over at PepsiCo. A lot of activist activity we've seen this year.
Yeah, absolutely. That is certainly heating up. And PepsiCo, just the latest, as you mentioned, we have a great guest coming up next to talk about all the activist scrutiny. We're going to speak with the partner and co-chair of Sidley Austin's shareholder activism and corporate defense practice.
This is Bloomberg.
We even came up with a strategy called the outhouse theory. If you're going to do what you regard as an uncertain acquisition, buy it into a standalone capital structure. Be willing to pay whatever the debt risk represents. Make sure you can refinance it timely if it works. And if it doesn't work, structure it so it doesn't poison the whole barrel of apples.
And that, of course, was legendary and very acquisitive Liberty Global Chairman John Malone, speaking a little bit earlier with our very own David Goyal about his strategy when it comes to deal making. And deal making, well, it's been hot as of late. This is shareholder activism is on the rise, particularly with the number of food-related companies facing scrutiny, from PepsiCo to Performance Food Group. Joining us right now to discuss sort of what's actually fueling this trend is Liekefett. He's a partner and co-chair of Sidley Austin's shareholder activism and corporate defense practice, which has been ranked #1 for legal shareholder activism defense in North America by Bloomberg. This must be a good time for you. And
it's a great time, yes, and thanks for having me. Yeah.
But I do want to go back to kind of the origins of the time that we're in now and some changes to proxy rules. And you have some data showing maybe the result of those changes, and this goes back to a rule change by the SEC that I think took effect in 2022.
That's correct. So in 2022, the SEC adopted what we call the universal proxy rules. And essentially what they did is, it's a technical change, but we expected it to have a huge impact, is it allowed shareholders to choose between director candidates of the dissident and director candidates of the board. So they can mix and match. That was previously not possible. activists had to push shareholders to vote on their card versus a company card. So it was binary before, and now you can mix and match.
I would think that would be a good thing if you are a deal maker. Does the data show that they've been more successful since the universal proxy rule went into effect?
That was the expectation. Yeah. So we went through hundreds of proxy fights and looked at the data of 5 years of proxy fights prior to the rule change and 3 years afterwards. Was an enormous amount of effort by hundreds of hours of work. And what we found is that actually the rule change was beneficial to companies. Oh, really? Which was counterintuitive. Oh. Okay. So what we found is that still in the majority of all proxy fights, under the new rules, management sweeps the outcome, meaning they don't lose any seats to a dissident. And in those proxy fights where management loses seats to the dissident, it's typically just one seat. So that's the most common success for a dissident is one seat. Yeah. And typically, it's not even the activist principal. It's an independent director candidate. In other words, someone you can live with.
And just to be clear, you're talking about the proxy battles that went all the way to a vote, right?
That's right. Okay. I'm a professional proxy fighter. I fight proxy fights for a living. No one else enjoys this as much as I do, and maybe you, because the media loves proxy fights. But that's what I do.
That's the new superhero, right?
Yeah, it's the proxy fighter. Yeah, it's certainly fun to talk about. I am curious, though. I mean, you think about this rule change. It happened about 3 years ago. These proxy fights, are they totally isolated from the macroeconomic environment? Because we often talk about them in the same breath to deal making, for example, and we know that that can be tied very closely to what we're seeing actually in the economy.
No, absolutely. You're totally right, Katie. It is tied to the overall economic environment. Just with any election, direct elections don't take place in a vacuum. The macroeconomic environment plays a huge role. So just like we saw in 2020, where we could tell shareholders, look, we are dealing with a pandemic, don't bother us with a proxy fight right now, that we could say something similar this year when the trade war started in the middle of proxy season. We could convince shareholders, look, please have our back. We need to rearrange our supply chains. We don't have time for this nonsense that the activist is pursuing.
And Kai, I'd love to get a little bit more specific here and talk about what's going on, particularly in the food and beverage industry. As Romain mentioned, we've seen a lot of activity there. PepsiCo comes to mind this week with Elliott coming in there. I wonder what you make of the activity there.
So, I mean, Pepsi, I would come after Pepsi for a different reason. Just doesn't taste as great as Coca-Cola, right?
Shots
I mean, that probably won't get me hired, but I mean, that would have been my thesis. Why doesn't taste it better?
Yeah.
But yeah, Elliott is going after large mega cap companies. They put allegedly $4 billion at risk here. By the way, realistically, it's a significantly lower sum. They're very smart. They're hedging. So they put significantly less than $4 billion at risk. But it's going to be interesting how much success they're going to have here.
I am curious about the success you have with the company, the scale and size of Pepsi, which obviously has a lot of power to fight back, versus other companies that maybe are a little bit on the smaller side, maybe just don't want to deal with a long, dragged-out fight, and maybe they'll just settle with the activists just to get them out of their hair and move on.
Yeah, in my experience, it's actually rather the opposite.
Okay.
The big companies rather want to settle quickly, because they're in the spotlight. You're talking about them. You're not talking about the sub $1 billion companies, right, on television. So the difference is that we actually see the most proxy fight activity that goes to a vote at smaller companies.
With regards to settlements, I know there's been a lot, and I haven't seen really reliable data on it, and Bloomberg tries to track this stuff, but it does seem like there are a lot more settlements going on. So basically, settling this matter before it gets to a proxy vote. Are you seeing a trend in that at all? I know you focus more on the stuff that gets to the finish line, but...
No, we looked at settlements as well. It's a good question. But we saw that there was initially, after the new rules took effect, there was a spike in more settlement activity, I think spurred by the urban legend that, well, now with the new rules, activists are prone to win lots of broad seats. And I think the reality has set in that that's actually not happening. Activists typically win only one board seat, rarely more than one board seat, if any, in proxy fights. So settlements have actually gone down, and we see more or less the same level of settlements now than we saw on average in the 5 years before the rule change.
All right.
All right, Kai, really enjoyed this conversation. Great to get some time with you. That is Kai Liekefett. He is partner and co-chair of Sidley Austin's Shareholder Activism and corporate defense practice.
And speaking of M&A, Cadence Design Systems, of course, makes the software to design semiconductors, said to actually be buying the Hexagon Design Engineering Unit from Hexagon, the engineering unit from Hexagon, for about 2.7 billion euros. Of course, Hexagon, a European company, Cadence based here in the U.S., a transaction that the company says it can close by the first quarter of the year.
Yeah, we'll continue to keep an eye on that one. Certainly, summer is over. There is a lot going on. Let's get to some of the biggest after-hour movers right now. We have to start with DocuSign. You can see that shares are higher by about 7% right now. We know that was a beat and raise quarter. We have Broadcom up at the top. This is an important one. You can see that traders are still trying to decide how exactly they feel about the figures that we saw. They weren't bad. Maybe they just weren't as good as folks were hoping.
They weren't as good. I'm curious to see what they say on the conference call. I'm also curious to see what that Lululemon conference call is going to be like. This is the third straight quarter here that they've disappointed investors big time.
Yeah, big time. Lululemon shares down about 13% too right now. All right, we have much more coming up on the close. Don't go anywhere.
The business of sports in focus today with the Power Player Summit underway here at Bloomberg headquarters. And a big focus has been the embrace of women's sports. So let's look back in history at the biggest live women's sporting event of all time. Picture it. Mexico City, September 5th, 1971. Football teams from Denmark and Mexico facing off before a crowd of 110,000 fans at Azteca Stadium for Copa 71. An unofficial but monumental World Cup match. While women's international football, or soccer as we call it here, had been played since at least the 1880s, FIFA had actually refused to sanction the matches. And most women's clubs at the time, they had to practice under the radar, as many countries, including the UK and Brazil, actually banned women participation in official national tournaments. But by the 1960s, the second wave feminist movement was creating more opportunities for women in academia, in the workplace, and in athletics. An Italian women's league decided it was time to stage a true international tournament, first in 1969 and again in 1970. While the early matches only drew about 2,000 to 3,000 people, the final in 1970 drew close to 40,000. While that was only a third of the attendance for that year's official FIFA Men's World Cup, it was enough to embolden organizers. With better marketing and even better players, Copa 1971 kicked off with 6 teams battling over 21 days of matches. Attendance swelled from around 10,000 for some of the early matches to 60,000 for the late games, to an overcapacity crowd of 110,000 fans for the final. It was then, and remains now, the highest live attendance for a women's sporting event on record. Now, sadly, it would take FIFA 20 more years to give women their due, when in 1991, it officially sanctioned for the first time a FIFA Women's World Cup. Now, things, of course, are moving a lot faster these days. The draw and money for women's soccer, unignorable. And it may be a fitting bookend. Mexico appears poised to host the 2031 Women's World Cup. And while the potential venues have yet to be named, that legendary Azteca Stadium, it still stands. And it would certainly be fitting to see the women of the modern FIFA era take the pitch where their predecessors blazed a trail more than 50 years ago.
And staying in the soccer space, MLS is one of the fastest growing soccer leagues in the world. The league started in 1996 with 10 teams. It has since tripled that number to 30 teams today, and that momentum is only growing. Joining us now to discuss, I'm pleased to say, we have Don Garber. He is commissioner of Major League Soccer. Don, great to see you.
Good to be here.
So professional soccer, it's always been a question why it isn't bigger in the U.S. because everyone, it feels like growing up, plays soccer in some form. It sounds, though, that the story is starting to shift.
Yeah, I think the question is, what does big mean? We had a match last Sunday in Seattle. There were 70,000 people in that match, and it was a tournament that we do with the Mexican League. It wasn't even a league MLS match. Messi in Miami is filling stadiums across the country. Our league is now 30 teams. The value of the enterprise is over $20 billion. So I think the real question, particularly here in America, is where is it in relation to the NFL? Where is it in relation to baseball and basketball and hockey leagues that have been around for 100 years? But we'll see with the World Cup coming here now, soccer is massive in this country. We've become the world's ATM by the size and value of our commercial opportunities with the rest of the soccer world. So while best days are still ahead, it's still doing pretty darn good.
I'm glad you brought up the league table. Of course, you have football, basketball, the big ones, baseball too, up there as well. I follow the sport of track and field very closely on a professional level, and that question exists. How do you make track and field the number 5 sport even? It sounds like, though, soccer has bigger ambitions than the 5th slot.
Yeah, we're here to talk about soccer. What I'll say about track and field, you need a professional business. So relating it to soccer, the World Cup here in '94, the last time it was in the United States, there was no professional league for the men or the women. The commitment that U.S. Soccer, our governing body, like USA Track and Field, was to FIFA, bring the World Cup and we'll build a Division I league. And that was 30 years ago, and here we are with 30 teams. So you got to have a professional business with owners, with stadiums, with community engagement, with players that are supported by unions and commercial media deals and sponsorship deals. That's what exists for soccer and the men's side, and certainly with the NWSL, which will be powered, to your point, by the World Cup Women's World Cup if it comes here in 2031. You got to have teams and boots on the ground to build a professional sports business.
And we should point out, too, that sort of the growing popularity of soccer in this country, obviously the World Cup, and particularly the U.S. winning the World Cup and in some of those events, was a big part of it. But there was also this idea of sort of the big players from overseas coming to the U.S. I'm old enough to remember Pele and how much attention that brought here in the U.S. when he came in the twilight of his career to play in the U.S. We still see that playing out today with names that you mentioned like Messi and a few others. But I am curious as to when we get to a stage where, A, we have homegrown players that are just as big as what we're seeing out of Europe and Africa and the Middle East, or more importantly, when some of those players in Europe, Africa, and Middle East decide to come to the U.S., not in the twilight of their careers, but in the prime.
Yeah, so, I mean, that is the secret story, if you will, that we've just got to tell a better story at. When David Beckham came here, he was 31 years old. He was in the prime of his career. And there were those that thought, well, David came here to retire. He played for 5 years. He's now a co-owner of our team in Miami. Homegrown players coming up through our academy system where hundreds of millions of dollars are being invested by MLS teams and academies that are developing players from U19 to U14 that are being sold to European clubs or being developed here and playing for MLS teams. We spent $300 million on bringing in players from the rest of the world and basically sold about $80 or $90 million of young American players that have been sold to abroad. But it is about time. MLS is 30 years old. The rest of the football leagues around the world are 100 years old. We feel really good about the trajectory and achieving the kind of values for teams and values for fans and values for the community. But it's still early.
Well, speaking of fans, and I'm talking about the people who actually attend the matches, talk a little bit about kind of the build-out and improvements in the stadiums, and more importantly, the experience. I was living in Washington, D.C. when D.C. United came, and they were kind of playing in the old RFK, which was kind of a dumpy stadium. But that's kind of, and that seemed to be the blueprint for a lot of MLS teams at the time. Now that's kind of been turned on its head. You're getting dedicated stadiums built for these teams now that may maybe not be as big as some of the NFL stadiums, but certainly in terms of amenities are probably just as plush for the fans.
Yeah, you can't, my view, and I've been the commissioner for a really long time, we had one stadium that was built in Columbus. We now have 26 soccer stadiums, billions and billions of dollars of public-private partnership or just owner capital. Our owner in Chicago, Joe Mansueto, a financial guy from Morningstar, is building a stadium downtown Chicago. It'll be privately financed. Our stadium in Miami.
Hometown, by the way. And the fact that he's building it downtown.
It's going to be awesome.
Give him a thumbs up for me next time you see him.
Miami will open up their new stadium next year in March. And Messi, we hope, will re-sign and we'll open up that stadium next year. And in New York City, right here downtown, the team is owned by the Citi Football Group that owns Manchester City. And those are 3 stadiums 30 years later in 3 really big markets. So the fan experience is what's driven 12 million fans to come through our stadium. It's the second most highly attended soccer league, football league in the world. We're proud of that, but you got to have a good fan experience. Now, as you live here in New York, you don't think about going to a baseball game at Yankee Stadium and say, well, what would the Yankees be without Yankee Stadium? But when you're a DC United fan, now you can't imagine what that would be like not playing downtown in Audi Field. And that's just part of the journey, part of what the Women's League is embarking on now and building a stadium. I was in Kansas City yesterday. Kansas City Current have a great downtown stadium for their team. And, lots and lots of investment that will deliver value for fans, which is ultimately what it's about.
I do want to talk to a little bit about the World Cup. Obviously, this is going to be a big event, one way or the other, and the idea that it's being hosted by North America, if you will, I guess with the three main countries here. There has been some concern about immigration and policies in the U.S. and whether that might hamstring some of the attendance, at least on the U.S. side. In fact, just as we're speaking now, the finance minister for Mexico City is speaking with one of our other Bloomberg properties and saying he actually thinks that some of the attention will shift in terms of the fan experience to Mexico at the expense of the United States. Are you worried about that?
You know, listen, as a fan and as a stakeholder, you're always worried about anything that could impact a big event. You'd like to control as much as you can. There's a very close relationship between the administration and FIFA. I'm confident that they will be able to manage through some of these issues and the stories and noise of what might be. I'm hopeful and confident won't be, because at the end of the day, we want the World Cup. The governing body does, our country does. We want it to be as big as it possibly can be. And it's going to be massive, to your point, bigger than anybody ever imagined. But you do have to have people who want to feel that they can get into our country and that they can be safe here. And I know there's a lot of people working on that.
Really great, Don, and we really can't understate just how much, soccer has grown in this country. I remember as a kid, there was no real option to kind of watch a lot of professional soccer and to see how far it's come in a relatively short period of time. People forget, the NFL was kind of a podunk league for about, 30 years before it finally blew up. Don, great to have you, fresh off the stage of the Power Players Summit. Don Garber, Commissioner of Major League Soccer. When we come back, we're going to take a closer look at what's going on in Washington, a big jobs report tomorrow, and more concerns right now about leadership of some of the federal agencies, Trump now taking aim at the Federal Trade Commission. This is Bloomberg. All right, welcome back. I need to make a quick correction. A little bit earlier, we were talking about some pressure on the Federal Trade Commission in the U.S. by President Trump. The idea that the FTC chairman, Andrew Slaughter, was apparently being forced out. We need to correct that. Rebecca Kelly Slaughter, an FTC commissioner, is now under pressure by the Trump administration. They have been trying to block her reinstatement, and now the Trump has gone to the Supreme Court seeking the ability to fire Rebecca Kelly Slaughter. Greg Stohr joins us right now from our Bloomberg studios in Washington, D.C. Greg, kind of explain what's going on here.
Yeah, Romaine, this is all about these independent agencies that proliferate across the government, and Congress has set those up in a way that the leaders of them, the commissioners or the directors, can't be fired by the president except for a particular reason. And the Supreme Court has been gradually saying, no, those restrictions are unconstitutional. They're an infringement on the president's power. And this case is a latest iteration in that, and the reason it's especially important is that it involves the Federal Trade Commission, and it could let the Supreme Court overturn the 1935 decision that made all this possible, that said Congress could protect leaders from being fired by the president. And at the end of the day, what it could mean is that the president will have much more control over these independent federal agencies. Side note, this may or may not be about the Federal Reserve. The Supreme Court has said the Federal Reserve is different. We're not saying that Donald Trump can fire the chair of the Federal Reserve for any reason, but there is, of course, that whole issue involving Lisa Cook, where the president is trying to fire her for a particular reason, and so that's a separate legal issue.
All right, Greg, appreciate your reporting. That is Bloomberg's Greg Stohr with the latest out of Washington. Let's quickly turn to some of the biggest movers after hour. We are still in earnings season. I want to talk about Lululemon. That is the most dramatic mover on the board. Shares down almost 14%. We know they cut their full year EPS forecast, getting a little bit more commentary out of the CEO now.
Basically saying product cycle's too long, assortment was stale. Also talking about the de minimis exemption that dropped from 800 to 100, saying that hit profit guidance. And also the company talking about this idea of what changes maybe they can do to actually sort of reboot this brand, a brand that we actually wrote about here at Bloomberg earlier today, the idea that they're leaning a little bit more heavily on superstar athletes, that endorsement model that Nike and Adidas and others have taken.
Yeah, taking a page out of Nike's playbook, but we know that Nike is not without their own issues as well. So really interesting times when it comes to apparel.
All right, that does it for us here on The Close. Katie and I will be back tomorrow for all your market moving coverage. For everything going on in Washington, stick around. Balance of Power is up next.